Hi, I'm Jim and I was retired. I asked viewers to share their overall asset allocations and I got a wide range of ideas. So in this week's video, I'm going to discuss asset allocation in retirement and discuss why I'm using a rising equity allocation in retirement. Stay tuned. Now, the ideal asset allocation in your DIY retirement really depends on your personal financial situation, your risk profile, what other income you might have in retirement, like pensions or Social Security, or continuing to work in retirement. Hey, before I continue though, will you please take a moment to like, share, subscribe to this channel, and hit that bell notification if you like entertaining ideas from one DIY retiree. Thank you. Now, the survey responses on YouTube and my X feed, 11% said that they were using 40% stock and 60% bonds. 21% said that we're about a 50-50 allocation. 30% reported that they were using a classic 60-40 allocation of 60 stocks and 40 bonds. And about 38% were all over the place. Now, some of those that said that they were other really were traditional 60-40 or 50-50, but the other answers varied from 70-30 to 80-20 to 90-10. And even this one, who was 100% stock, and I'm guessing that retiree is using other income to pay for expenses rather than investments. One of the rules of thumb in asset allocation is a conservative one. Take 100 minus your age, and that's the amount of equity that you should have in your portfolio. And at one point in my DIY retirement, I was using a slightly more moderate rule of thumb of 110 minus my age. And if you were even a little bit more aggressive, you could have used 120 minus your age. But even that would have started my retirement with about 61% equity and dropped down to 52% versus 41% for the most conservative rule of thumb, dropping down to 32%. Still others advocate sticking with a 60-40 mix shown here in orange. I've been switching to a rising equity allocation. Began about 40% when I began retirement to about 60 now, and I'm thinking of going higher to 65 or 70 in the coming years. One of the arguments for this rising equity glide path is to protect against inflation in later years. Equity has been a great long-term protection against inflation. On the other hand, the declining equity standard of that X minus your age was designed to reduce the sequence of return risk in retirement. A series of double-digit losses in your portfolio, especially in the first few years of retirement, could seriously erode retirement assets. Yet, my three-bucket strategy is another way to protect against sequence of return risk by giving you that cash cushion so you do not need to sell equities when they are down. When I was retired in 2015, I had about 3 years' worth of expenses in a cash cushion, which became my bucket one in retirement. Now, we first relied on that cash cushion while we figured out our retirement plans. Today, about 18% of our portfolio is in bucket one, cash and equivalents to cover 3 years' worth of expenses. 32% of our portfolio is in bucket two with income-producing assets that will cover expenses for years 4 through 8. And bucket three, about 50% of our portfolio is long-term equity investments. Now, this bucket strategy gives us the ability to weather market downturns. In my last video, I showed you how I use Quicken for Mac and download the data into my spreadsheet. I also focused on the Quicken for Mac dashboard function, which offers its own asset allocation pie charts. I decided to use that function and the time machine function, where you can look at your portfolio at various dates, to go back and look at the asset allocation through the 9 years of our retirement. You see, one of the problems in the first few years was data quality. 55% of the assets were unclassified. Now, sometimes this was a fund like my 401k fund that was an asset allocation conservative, with no data reported to Quicken on what the allocation should be. Also, keep in mind that this view of Quicken is only the investment accounts, your brokerage and retirement accounts, so it doesn't include bank accounts, your checking and savings accounts. So cleaning up that kind of data was why I created my spreadsheet to download the Quicken data, add my own definitions for asset allocations, and get a better handle. This continued for the first few years. We began our DIY retirement first by consolidating retirement accounts, merging old IRAs into a solid single IRA account, for instance. We were also second guessing some of the actively managed mutual funds and target date funds. Target date funds sound great as you're saving for retirement, but once you're in retirement, they have some problems, which I've discussed before. I've also focused on reducing net expense ratios. Actively managed funds and even target date funds have higher expenses than pure basic broad index funds. By 2018, unclassified was under 5%. Domestic bond was about 65 at year end, and another 10% was in cash and money market. Equity was about 25%. I'm guessing we did a lot of rebalancing that January. In my 401k, I was moving away from those overall asset allocation funds, like the conservative fund, into individual equity and bond index funds, shown on the left there. Overall mix was getting closer to 45% equity, 65 bond and cash. And by year-end 2020, we were getting closer to 50-50. And by the way, in 2020, when everything went down, we held because we had a strategy and waited for the market to return. 50-50 remained our target for a number of years. Notice the two active Vanguard funds, Wellesley Income and Wellington Funds. They were major components of our portfolio, and I began exploring ways to reduce the costs of those actively managed funds with lower cost ETFs. At the same time, we were moving closer to a 55 equity, 45 bonds in 2022. In the last 2 years, we've moved closer to 58% equity, 42% cash and bonds. Notice on the bottom on the left there, we also began using individual treasuries and TIPS, and we moved away from the bond mutual funds and ETFs that disappointed us in 2022. According to the Quicken data, again, without the cash in the bank, just the investment accounts, we were closed 2024 with about 61% equity and 39% cash and bonds. My portfolio by bucket spreadsheet, which includes the cash in the bank, also includes more detail in the kinds of assets. Equities, for instance, breaks out large cap and small cap and REIT funds, for instance. And the bonds have been broken down into corporate bonds, I bonds, TIPS, treasury notes, and treasury bills. This pie, which includes the cash in the bank, is about 58% equity and 42% cash and bonds. In our target asset allocation, we're lighter in international stocks than others. Morningstar, for instance, recommends 12 to 20% of international stocks in their model retiree portfolios. But I believe that U.S. stocks, especially large caps, already have a lot of international exposure. Besides, in recent years, the international mutual funds and ETFs have not been great results. Also, on I bonds and TIPS, I aim for about 25% of my bond holdings to be in these two inflation protection categories, mostly in bucket 2. Empower, which was formerly Personal Capital, recommends your portfolio changes if you load everything in. And right now they recommend 20% international stock compared to roughly 5% for my allocation now. Again, I don't know. Empower and Morningstar might be right, but personal finance is personal, and I'm comfortable with less international exposure. By the way, Empower also has a great way of analyzing fees, and you can use that not just for retirement fees, but for all of your accounts. When you do that, I can look at my net expense ratios for the whole portfolio, and we're down below 0.02% for all accounts. Hey, asset allocations is personal. You are best setting a target and sticking with it and making it your target rather than trying to chase market trends. And this gives you a way of guiding your decisions on your portfolio against a target that you've set based on your own risk profile and circumstances. And hopefully you'll have assets there for future expenses in your DIY retirement. I will conclude with my standard warning. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. Bye.